Google just announced $185 billion in AI spending for 2026. Wall Street expected $115 billion. Google nearly doubled expectations, and the market crashed. S&P 500 down 1.2%, NASDAQ down 1.5%, AMD down 17%, silver down 13.3%, Bitcoin tumbling. But here's what makes this terrifying. Google beat earnings. Revenue $113.8 billion versus expected $111.3 billion. Earnings per share $2.82 versus expected $2.64. Cloud revenue up 48%. These are spectacular numbers. And the stock fell anyway. This is the moment when the market says AI spending doesn't justify revenue. When $185 billion in capital expenditure becomes a warning instead of promise. When investors realize billionaires who sold months ago knew this was coming. Let me show you what happened in the last 24 hours, why Google's announcement crashed the market, and why this confirms everything billionaires warned about. Start with the timeline because sequence matters. February 4th, after market close, Google reports Q4 earnings. Numbers are strong. Revenue beat by $2.5 billion total. Earnings beat by 0.18 per share. Cloud segment exploded with 48% growth. YouTube steady. Search growing. Everything looks perfect. Then CFO Anat Ashkenazi delivers the guidance. Capital expenditure for 2026, $175 billion to $185 billion. The number lands like a bomb. Analysts had modeled $115 billion. Some optimistic estimates reached $120 billion. Nobody expected $185 billion. That's double last year's $91.5 billion. That's more than Google spent in the previous 3 years combined. The market processes this overnight. February 5th, markets open. Google stock drops despite beating earnings. Tech stocks follow. AMD crashes 17%. Tesla down 3.8%. Nvidia down 3.4%. The selling spreads. S&P 500 falls. NASDAQ falls harder. Commodities collapse. Silver down 13.3% in wild swings. Gold down 2.3%. Bitcoin tumbling. Flight to safety as Treasury yields drop from 4.29% to 4.21%. This isn't just Google falling. This is the entire AI thesis getting questioned in real time. And the question is simple. If Google needs to spend $185 billion to compete in AI, and that spending crashes the stock despite record earnings, what does that tell you about AI economics? Now let me show you what Google is actually buying because $185 billion doesn't disappear into thin air. It buys data centers, thousands of them. Buildings filled with servers running AI models 24/7. It buys chips, NVIDIA GPUs at $30,000 each, custom AI accelerators, hundreds of thousands of processors. It buys energy infrastructure, nuclear power plant deals, renewable energy contracts, cooling systems. The electricity cost alone is staggering. It buys networking, fiber optic cables connecting data centers, high-speed switches, the infrastructure to move massive amounts of data instantly, and it buys real estate, land for data centers, buildings for equipment, physical space for the AI empire. Google CFO said this spending goes toward AI computing for Google DeepMind and meeting cloud customer demand. She emphasized the $240 billion cloud backlog, up 55% from previous quarter, more than doubled from last year. Translation: Google has signed contracts for nearly $250 billion in cloud services it physically cannot deliver without building more infrastructure. This is the trap. Google committed to customers. Those customers expect AI services. To deliver those services, Google must spend $185 billion building capacity. But here's the problem, that $185 billion comes out of cash flow. It reduces profit margins. And if AI revenue doesn't grow fast enough to justify the spending, shareholders lose. The market sees this trap clearly. That's why the stock fell despite beating earnings. Investors aren't worried about Q4 2024. They're worried about 2026, 2028, when depreciation from $185 billion in assets hits the income statement while AI revenue growth potentially disappoints. Now let me show you why this confirms the AI bubble thesis. Remember our AI bubble video, $200 billion spent by Microsoft, Amazon, Google, Meta. Revenue not justifying investment, the math not working. Billionaires selling before the bubble pops, that was the warning. Google's announcement is the confirmation. $185 billion in 1 year from one company. That's larger than the GDP of most countries. That's more than Finland's entire economy. Google is spending nation-state money on AI infrastructure. And the market response tells you investors don't believe the returns justify the investment. Compare this to Meta's CapEx guidance, $115 to $135 billion for 2026. Microsoft spending $37.5 billion in a single quarter. The entire big tech cohort is locked in an AI arms race where spending accelerates but monetization remains unclear. Google's $185 billion is the most explicit statement yet. We're spending everything to win AI, regardless of near-term profitability. This is exactly what Bill Gates saw when he reduced Microsoft 55%. He saw internal CapEx plans, he saw the spending explosion, he knew revenue wouldn't keep pace, So he sold. Jeff Bezos saw Amazon's AWS competing in this arms race. He knew the margins would compress. He sold $8.5 billion. Warren Buffett watched from outside. He saw the entire industry spending hundreds of billions with uncertain returns. He held $325 billion cash instead. These billionaires weren't guessing. They were reading the same internal projections that led to Google's $185 billion announcement. They knew this moment was coming. They positioned months in advance. And now the market is catching up to what they already knew. Now let me show you the earnings contradiction because it's revealing. Google reported spectacular Q4 results. Cloud revenue $17.7 billion, up 48%. Cloud operating income $5.3 billion, margin over 30%. These are the numbers bulls dreamed about. Cloud finally profitable at scale. AI driving real revenue growth. The monetization story working. So why did the stock fall? Because $185 billion in spending overwhelms $5.3 billion in quarterly cloud profit. Do the math. Cloud generates roughly $21 billion in annual operating income at current run rate. But Google is spending $185 billion in a single year on infrastructure. That's 9 years of cloud profit consumed by 1 year of CapEx. The ratio doesn't work. Investors understand that most of that $185 billion gets depreciated over 3 to 5 years. So annual depreciation expense will be $37 billion. That's $37 billion in costs hitting the income statement every year, while AI revenue needs to grow enough to cover those costs and still generate acceptable returns. If AI revenue disappoints, margins collapse. This is the risk the market priced in instantly, not current performance, future economics. And the future economics of spending $185 billion on AI infrastructure look increasingly questionable when even Google's best case revenue growth barely justifies the investment. Now let me show you what happened to the rest of the market because Google's announcement triggered a cascade. Tech stocks fell immediately. AMD crashed 17% as investors realized chip demand might peak as cloud providers max out spending. If Google is already spending $185 billion, how much more can chip companies expect to sell? Nvidia fell 3.4% on the same logic. Tesla fell 3.8% as contagion spread. But the selling didn't stop at tech. Commodities crashed. Silver down 13.3% in violent swings. Gold down 2.3%. Both had been rallying as safe havens amid market uncertainty, but Google's announcement suggested the AI bubble might pop sooner than expected. Risk-off accelerated. Bitcoin tumbled as crypto followed traditional markets lower. Treasury yields dropped sharply as investors fled to safety. The 10-year yield fell from 4.29% to 4.21%. That's a massive one-day move in bond markets. It signals fear. Investors selling stocks and buying government bonds. Classic flight to safety during crisis moments. And there's another signal buried in the market action. Jobless claims jumped 22,000 to 231,000, the highest in 2 months. Weakness in the job market emerging simultaneously with tech spending concerns. The SARM rule sitting at 0.35, just 0.15 from recession trigger. Multiple warning signals converging at once. This is the environment the billionaires saw developing, not just AI spending concerns, multiple systemic risks building simultaneously. Google's announcement was the catalyst that made these risks visible to everyone. The billionaires positioned months ago. The market is positioning now, and anyone still long tech at current valuations is hoping the billionaires were wrong. Now let me show you the competitive dynamics because Google isn't alone. Meta spending $115 to $135 billion, Microsoft spending aggressively, Amazon expanding AWS. Every major player locked in the same arms race. And when everyone is spending hundreds of billions, margins compress across the industry. This is the tragedy of the AI commons. Each company must spend to remain competitive, but collective spending reduces returns for everyone. Google spending $185 billion forces Meta to spend $135 billion. Microsoft sees both and increases spending. Amazon matches. The spiral continues until someone breaks, either spending slows and companies lose competitive position, or spending continues and profits evaporate. No good outcome. The market is pricing in this reality. That's why tech stocks fell despite strong earnings. Investors see the trap. The AI arms race has become a prisoner's dilemma, where rational individual behavior leads to collective destruction of shareholder value. Now let me show you what this means for the timeline, because Google's announcement accelerates everything. The AI bubble doesn't pop in 2027 or 2028, it pops in 2026, possibly Q1 or Q2. Why? Because spending at this scale creates quarterly comparisons that become impossible to justify. Google will spend $46 billion per quarter through 2026. Every earnings call, investors will ask about returns on that investment. Every quarter, Google must show AI revenue growth that justifies $46 billion in capex. If any quarter disappoints, if AI revenue growth decelerates, if margins compress, the stock crashes. And Google isn't unique. Every major tech company faces the same quarterly scrutiny. The billionaires knew this timeline. That's why they sold aggressively in Q4 2024 and Q1 2025. They knew Q1 and Q2 2026 earnings would expose the AI spending problem they positioned before it became obvious. Now let me show you what you should do, because this moment requires action. First, recognize Google's announcement as a major inflection point. This isn't normal capital allocation. This is crisis spending. When a company doubles capex guidance beyond analyst expectations, it signals desperation, not confidence. Google is terrified of losing AI leadership. That fear is forcing spending that destroys shareholder value. Second, reduce exposure to tech stocks immediately. The AI arms race is accelerating beyond rational economics. Companies are spending hundreds of billions with unclear returns. That's bubble behavior, and bubbles pop. The billionaires are already out. Follow them. Third, avoid the entire Magnificent Seven: Google, Microsoft, Meta, Amazon, Apple, Nvidia, Tesla. These 7 stocks represent 32% of the S&P 500. All are exposed to AI bubble dynamics. When the bubble pops, these stocks fall 40-60%. Your index fund falls with them. Get defensive. Fourth, increase cash holdings significantly. The billionaires are holding record cash. Buffett, $325 billion. Bezos liquidated billions. Gates reduced equity exposure. They're waiting for the crash to buy assets cheap. Position the same way. Fifth, watch the next few earnings calls. Google's $185 billion announcement was the first shoe. Meta, Microsoft, Amazon report soon. If they match Google's spending, the bubble accelerates. If they don't, they lose competitive position. Either outcome is negative for valuations. Google just spent $185 billion on AI. Wall Street crashed in response, not because earnings were bad, earnings were spectacular, but because $185 billion in spending reveals the AI economics don't work. Revenue can't justify investment. Margins can't support the capex. Returns can't meet shareholder expectations. The billionaires saw this coming. They sold months ago. They positioned at 4.7 to 1 insider selling ratios. They watched the SARM rule approach 0.50. They tracked concentration risk in the Magnificent Seven. They analyzed AI capex versus revenue. And they concluded the math doesn't work. So they exited. Google's announcement proves them right. $185 billion in AI spending crashed the market despite record earnings. That's the signal. The AI bubble is popping in real time. The question is whether you'll position with Idalea. Ates, najbates to sugrzentik bit galerius neromanins, atsatis awiras or and you'll hold through the crash, hoping this time is different. The billionaires made their choice. The market made its choice today. Now you need to make yours.